What's going on, everyone, and welcome to your Financial Dose. I just wanted to start this video off by hoping that everyone is safe and inside during this very bizarre quarantine time. The virus has been shutting country after country, city after city down in the efforts to try to stop its spread, so I just hope you guys are inside and safe and doing all right. Now, I think a really good topic for today's video would be how to invest in a time of uncertainty like we're currently living in right now. Now, I think this is a very important topic, especially given the fact that over the past, 10 to 13 years, we've been pretty much living in a bull market and investing in a bull market. And the way you invest in a bull market and the way you may invest in an uncertain market or even a bear market is a little different, in my opinion, and should be. You should take a little bit of extra caution when you invest in uncertain times. And in my opinion, the following method is going to be one of the best ways that I think most people or the average investor should be using when it comes to investing in uncertain times. So essentially, what I would suggest is dollar cost averaging. And what that means would be investing a fixed portion of money at a fixed time interval. Obviously, you can be flexible on the amount and the time intervals if you need to, depending on your situation. But in theory, let's say you'd invest $100 a week over a year, for a total of $5,200, well, that would be dollar cost averaging your way into the market over a year by investing $100 a week. And the reason why this is so, important to do in uncertain times is that you don't really know in which direction the market is going to go. It's not trending in any direction. So if you were to invest all of your money, so let's say, for example, you had $10,000 to start with, and this $10,000, you won't be able to duplicate this or to invest more in the markets up until next year. So you have $10,000 today, and you only have, let's say, another $10,000 in a year from now. So should you invest all of the $10,000 today? Should you invest it in 6 months, or should you split it up over the course of that year? I'm really sorry about that, guys. My cat really wants to go outside, but it's pouring rain right now. So if you were to say, oh, well, let's just take the $10,000 and invest it today, the time where that would actually be good is if the markets were trending upwards, you invested $10,000 today, and a year from now, the markets go up 10%. You're very happy because you took that initial $10,000 and invested it all on day one, and the markets went up. Now, let's say you take that $10,000, you invested in the markets, and then the markets go down 10%. Had you, say, invested in 6 months from now, you'd have only lost half of the money, since we can assume that the market's been consistently going down month over month all the way down to 10%. So essentially what I'm trying to say is that it's very hard to time the market. In uncertain times, it would be great if you can buy the bottom and then hold it and watch all your portfolio increase in value as the stocks go back up to, let's say, a more normal level. But to be able to time this market, it's a very difficult task, and most people cannot do it, and it's not recommended that you try because you never really know when the market is at the bottom. So instead of trying to play that game and saying, oh, if I would have invested $10,000 a month ago, then I'd be so and so much richer, or oh, I shouldn't have invested my $10,000 because now I lost money. Well, to avoid all this sort of stress and psychological burden when it comes to investing in uncertain times, I would suggest, well, if you have $10,000 and the markets are uncertain, let's split that money up over time. Now, a quick example of how this actually works and why this is so powerful. Let's say you have two time windows where you're investing money, okay? So you're gonna invest money, let's say on day one, you're gonna put $100 and you're gonna buy a stock that's currently worth $10. So that means you have 10 shares at $10 for a total investment of $100. Now, let's say that same stock goes back down to $5 and you invest, again, $100, but instead of buying 10 shares, you're able to buy 20 shares. Now, you're still investing the same $100, but since the stock is half price, you're able to buy twice as many shares. Now, if the stock goes back at $7.50, so a middle ground between the $10 purchase price and the $5 purchase price, did you make money, lose money, or do you break even, since it goes in between the $10 purchase price and the $5 purchase price? The answer to that question is actually you make money. And how much money do you actually make? Well, if you invested $100 at the top, $100 at the bottom, instead of being at, what you would think of as $200, which would be the middle ground between the two, you're actually at $225. And the reason this happens is because when the stock price is at $5, you're able to load up on more shares than when the stock was at $10, which means that on the way back up, you end up making more money because you go back up with more stocks that you bought at a lower price. Now, using this logic in uncertain times, well, it's sort of a great strategy because you don't need to time anything. All you need to do is say, okay, I'm going to buy the index, or I'm going to buy this bank fund, or I'm going to even buy a stock. When you actually transact small volumes over long periods of times in small quantities as well, you need to be careful with commission, because if your broker charges you $10 per trade and you're only investing $100 at a time, you're essentially losing 10% of your money every time you make a transaction. So either instead of investing once a week, maybe you should invest once a month, or try to invest a little more money to make it more worth your while. Or a lot of platforms also may have free trading, or free trading for ETFs or exchange traded funds. And I like this option because, again, in uncertain times, picking and choosing a company can be great because the payoff can be amazing. But at the same time, if that company doesn't do so well in a recession, you may not want to be all in that one company. So I would suggest buying an index, especially if they're free to trade, or free to purchase at least. So that in that sense, if you want to purchase one index per day, or one unit of that index per day at $20 per unit, it's great because you don't actually pay commission on the purchase. You'll only end up paying commission on the sale. So in my opinion, that is the best way to actually average your way into the market in uncertain times. On some days, you'll wish that you invested all of your money yesterday because the market's bounced back 10%. On other days, you wish you didn't start investing yet because the market will actually drop below your initial or average purchase prices. So then you may be upset because you lost money, but at least you're getting into the markets at a discount compared to what they were, say, 2 months ago. And this is very relevant for this current time period because the markets have dropped up to 30% from their all-time high, which was not even 2 months ago, or maybe even a month ago. And now the stocks that are trading at a discount may not literally be at a discount. They're just at a discount compared to their all-time high, because maybe the new economic situation with the coronavirus actually impacted their business, which means that the companies themselves are worth less. But at the same time, in these very uncertain times, the market tends to panic and to panic sell. So either they're overestimating the damages that the virus will cause, or they're underestimating the damages. We don't really know yet because the actual overall impact that it will have on the global economy is still uncertain. But what is sure is that stocks have fallen greatly, and we are going to be in for a bumpy ride over the next couple months at the very least. So I would suggest using dollar cost averaging to enter the market as opposed to going in all in today, because if over the next 2 months we're looking at a bear market and stocks are still falling, you're going to lose a lot more money than you had to if you were purchasing smaller quantities at fixed time intervals. If you enjoy the content that I create, don't be shy to subscribe and click on the notification bell so you get notified every time I post a new video. Well guys, thanks for tuning in. I hope you learned something, and again, I wish you all the best. I hope you guys are safe and trying to make the best of your time inside, and I will see you in the next video.